Two people walk into the same dealership on the same Saturday. Same car, same price, same down payment, same salary. The salesman runs their credit. One drives home paying $387 a month. The other drives home paying $521 a month. Same car, same road, same life. The difference between them is not their job, not their income, not how hard they worked. It is a three-digit number assigned by a private algorithm that most people only partially understand and almost nobody knows is quietly billing them thousands of dollars a year. That number is your credit score. And from 300 to 850 is the most expensive number in your life that nobody ever sent you an invoice for. This is called poor credit. The industry term is subprime. The experience is something else entirely. You apply for an apartment, the leasing agent smiles at you when you walk in, shows you the unit, opens the closets, talks about the amenities. You fill out the application. 3 hours later, a form email arrives. We're unable to move forward at this time. No explanation, no phone call. The system ran your number and made its decision before you finished the tour. You apply for a car loan. The dealer runs your credit and comes back from his desk with a different posture than when he left. The rate he puts on the paper is 14.5% on a $25,000 car. That is $19,000 in interest over 72 months. You are paying for 2 cars and driving one. You try for a credit card. The card you qualify for has a $300 limit, a $75 annual fee, and a 29.99% APR. You have to pay them to give you access to your own credit ceiling. What nobody explains to you is this: the 14.5% rate is not just a number, it is a judgment. The system has decided you are a risk, and the price of being a risk is that every dollar you borrow costs significantly more than it costs the person sitting next to you with a different score. You do not know their rate, you do not know the gap. You just know the number on your paper and the payment you agreed to because there was no other option. You are still subprime, but the door is open now, barely, unevenly, with conditions attached that you did not fully read. You qualify for an FHA mortgage, the government-backed loan, designed for people at this tier. The rate the lender quotes you is 7.9%. On a $250,000 home, you will pay $366,000 in interest over 30 years. The home costs $616,000 in total. You also owe the FHA mortgage insurance premium, 1.75% upfront, plus 0.85% annually. The life of the loan on a $250,000 mortgage, that is $4,375 at closing and $2,125 every year until the loan is paid off. The insurance does not protect you, it protects the lender. You are paying for coverage on a risk the bank decided you represent. You get approved for a car at 12.4%. You get a credit card with a $500 limit and 24.99% APR. You are building. Technically, the architecture of your financial life is being constructed, but every beam costs more than it should because the number says you are still a risk, and the system prices risk onto the borrower, never onto itself. You cross the line. You do not feel it, but the system does. At 620, Fannie Mae's automated underwriting system, the algorithm that decides whether conventional lenders will buy your mortgage, changes its recommendation. You can now qualify for a conventional loan. The rate drops, not dramatically, 7.2% instead of 7.9%. On a $250,000 mortgage, that difference is $41,000 over 30 years. $41,000 that exists only because your score crossed an invisible threshold that no one told you was there. The FHA mortgage insurance disappears. The upfront premium, the annual premium, gone. Not because you became a better person, because the number moved. The apartment that sent you a form rejection at $590 calls you back at $625. The leasing agent who never called is now talking about move-in specials. Nothing changed in your life between those two numbers except the number itself. You get a real credit card, a $2,000 limit, a 22% APR, still expensive, but the limit is high enough to be useful. You exist now inside the system, not comfortably, not on favorable terms, but inside the door is open, you are standing in it. Good credit. That is the industry classification. The marketing language changes. You start receiving mail with your name printed correctly and offers that do not require a security deposit, pre-approvals that do not come with 3 pages of conditions in fine print. The car loan rate drops to 9.1%, still above the national average, still above what the person with the 760 pays, but below the double digits that define the last 2 tiers. You feel the relief of that drop without knowing what you are still leaving on the table. The apartment approves you on the first application. The landlord does not ask for 2 months security deposit. The leasing agent treats you like a customer instead of a variable. You qualify for a $350 credit limit card with 18.99% APR and an actual rewards program. Small rewards, but rewards. The system is starting to treat you like someone it wants to keep. Not warmly, not generously, but it is facing you now instead of turning away. What you do not know yet, what nobody at this tier knows, is that 660 and 760 are not 2 different points on the same spectrum. They are 2 different systems. You are still in the first one. Something changes at 700 that is not explained in any credit score article you have ever read. The rate on a conventional 30-year mortgage moves to 6.8% on a $300,000 to $50,000 loan. That is $82,000 less in total interest than the rate you were offered at $580. $82,000 that existed in the gap between 2 numbers. The credit card offers arriving in the mail are different now. Not secured cards, not store cards, actual rewards cards, 1.5% cash back, no annual fee, $5,000 starting limits. The car dealer runs your credit and comes back from his desk with the same posture he left with. No shift, no recalibration. He quotes 6.4%. He moves on. He has already decided you are someone the deal works with. You qualify for personal loans at 11% instead of 19%. You apply for an apartment in a building that rejected you at 610. You are approved in 48 hours, no additional deposit, no cosigner required. The system at 700 does not celebrate you, it just stops fighting you, and the absence of resistance feels, after years of the other experience, like something worth protecting. This is where the pricing gap becomes visible in a way you cannot unsee. At 740, Fannie Mae's loan level price adjustments, the risk-based surcharges added invisibly to your mortgage rate, drop significantly. The lender is not quoting you a lower rate because they like you. They are quoting you a lower rate because the secondary market that will buy your loan charges them less to guarantee it. The rate you see is 6.5%. The rate you would have seen at 620 is 7.2% on a $400,000 mortgage over 30 years. That is $68,000 in interest you are not paying. You did not negotiate it. You did not even ask for it. The system calculated it automatically from a number and applied the discount to your life without announcement. Your car loan is 5.1%. The same car that cost the $580 borrower $19,000 in interest cost you $7,200. You are driving the same road. The difference is $11,800 that exists only in the gap between your numbers. The credit card you carry now has a $15,000 limit, 15.99% APR, and earns 2% on everything. The system is not treating you better because you earned it. The system is treating you better because you hit a number that tells it you are no longer a risk. And once you stop being a risk, the price of everything gets cheaper, not by a little, by tens of thousands of dollars. You are in the top 23% of all credit scores in America. You do not feel different. Your morning looks the same. Your job looks the same. But the pricing on your financial life is quietly separated from the undone. Pricing on the life of someone at 620 in ways that are no longer incremental. They are structural. The mortgage rate you receive at 780 is 6.4%. At 580, it was 7.9%. On a $400,000 loan over 30 years, that gap is $118,000. $118,000, not in wealth, not in income, in interest. The cost of borrowing the same money from the same bank for the same house on the same street. The personal loan rate is 8.5%. The car loan is 4.8%. You walk into a dealership and the rate they quote you first is the rate they quote you last. There is no recalibration, no trip to the back office, no different posture when he returns. You qualify for a premium travel card, $10,000 minimum limit, airport lounge access, 3x points on travel and dining, a $300 annual travel credit. The card costs $550 a year. The $300 credit offsets it immediately. You are being paid to use credit that used to charge you for existing. The system does not announce when it starts treating you like an asset. It just does. Quietly, consistently, without ever sending you a bill for what it used to cost. The top 21% of all FICO scores, the rate you receive on a mortgage at this tier is the published best execution rate, minus the floor at major lenders in 2026. That is 6.3% on a 30-year conventional loan. On a $400,000 mortgage, you will pay $459,000 in total interest. The person at 580 buying the same house will pay $616,000. The gap between those two numbers is $157,000. That is not a gap in wealth. That is not a gap in income. That is the cumulative cost of a lower three-digit number applied to one financial decision. Add the car. The person at 800 finances a $30,000 car at 4.4% over 60 months. Total interest, $3,450. The person at 580 finances the same car at 14.5%. Total interest, $12,600. Gap, $9,150 on one car. Add the credit cards, add the personal loans, add the apartment deposits they never had to pay. Add the insurance premiums, yes. In most states, your credit score affects your auto and homeowner's insurance rate. Add all of it across a life, and the gap between a 580 and an 800 is not $91,000. That number is conservative. The real number across a full financial life is north of $200,000, paid not to a single institution, paid in fragments, $134 here, $41 there, a rate that was 7.1% instead of 6.3%, a deposit you never saw again, paid so quietly and so incrementally that most people never calculate it. They just live it without knowing what it costs. Here's the thing nobody explains about the credit score system. The number was not designed to measure your character. It was not designed to measure your intelligence, your reliability, or your discipline. It was designed to measure one thing, the statistical probability that you will miss a payment in the next 24 months based on the behavior of millions of people who had a similar profile at a similar point in time. That is it. You are not being evaluated. You are being averaged. The FICO model does not know that you missed 3 payments because you were in the hospital. It does not know that the collection on your report is a medical bill you disputed. It does not know that your utilization spiked because you used your card to pay rent during a gap in employment that lasted 6 weeks. The model knows the data points. It does not know the story behind them. And the pricing it generates, the rate the dealer reads you from a slip of paper, the number the leasing agent sees on a screen is the product of that averaging applied to your life, without appeal, without context, and without explanation. Here is what is almost never explained. The difference between a 620 score and a 750 score is not always behavior. Sometimes it is time. A person who made every payment on time for the last 4 years still carries the mathematical weight of what happened 5 years ago. A medical collection from 2020 still appears on a 2026 report. A late payment from a credit card you forgot you had still reduces a score that you have otherwise managed with complete precision for half a decade. The system does not weight recency the way you might expect. A 7-year negative item and a 6-month-old negative item both live on the same report and both suppress the same score. You can change your behavior completely and spend years paying the price for behavior you already changed. The most precise way to describe the credit score system is this. It is a tax, not a government tax, a structural one. It is levied not on income, not on wealth, but on risk and risk. As the system calculates it, correlates almost perfectly with the financial circumstances that people are born into, fall into, and spend years trying to climb out of. The person who needed the payday loan because their transmission failed did not become less reliable. They became less expensive to the system, and the system priced that expense onto every future transaction in their financial life. The gap between 300 and 850 is not a gap in character. It is a gap in the cost of every dollar you ever borrow, and the cost follows you into every room before you say a word. Somewhere right now, 2 people are financing the same car, same lot, same salesman, same Saturday. The rate on one paper is 14.5%, the rate on the other is 4.4%. Neither of them knows what the other is paying. The system does not announce the gap, it does not explain it, it just prices it quietly, automatically into the length of a loan. The weight of a monthly payment, a total number on a piece of paper somebody signed and drove away from. The credit score did not measure who they are, it measured what their file looked like on the day someone ran the number. The car is the same car, the road is the same road, the cost is not the same cost, it never was.